Welcome back to the Property Trio podcast, the podcast for the sophisticated property buyer. I'm your host, Cate, and I'm here with our property tax deduction expert, Mike, and of course, our mortgage strategy and property planning maestro, Dave. How are you both?
Very good, thanks. Not sure how I feel about being called a maestro, but
that's Mike's script. He loves calling you a maestro.
I think Anne-Marie started
here.
using that as well. Or ChatGPT.
Today's episode was actually inspired by a great listener question that landed in our inbox. And Dave, I will get you to introduce this and kick us off.
Yeah, look, when I read the question, my first thought was, we get this all the time at Property Planning Australia, and it set off a bit of a chain reaction for me. So if this one pops up so often, what other questions are people asking? So, and not just the common ones, but some of the quirky ones that borrowers throw at mortgage brokers. So we put this to our team, and our team came back with a bunch of questions that are commonly asked, and we thought we could unpack in an episode.
Oh, awesome. Well, that brings us to today. We're opening the vault and diving into the most frequently asked questions by borrowers and those looking to take out a mortgage, plus a few head scratches that only surface every now and then. So we'll start with a brilliant listener question we received from Callum, who asks, how is borrowing capacity affected by positively geared assets? And Dave, you've spoken about this a few times over the years as to how it works in theory. So we thought it was time to tackle an actual example. And Callum has provided this. Person A and person B both have the exact same salary of $100,000 each. Their expenses are $50,000, but person B also owns a property which is valued at $600,000 with $300,000 worth of debt. This property is positively geared and it's earning a net $10,000 each year. Does person B have greater borrowing capacity because they have a higher net yearly income of 110K versus person A's at 100K? Or does person B's $300,000 debt reduce their borrowing capacity? So two people have the exact same salary, the same living expenses, but one of them owns positively geared asset. So in real terms, they have more cash flow, but does that extra income push up their borrowing capacity, or does the existing investment debt hold them back due to the lenders shading off rental income and adding buffers onto the actual interest rates paid? And Callum, thanks for your lovely feedback. He did say, keep doing what you're doing. This show is going from strength to strength. Love your work. Thank you. You've made our day. Dave,
good question too.
Yeah, it's a great question.
Yeah. Great question. Thanks, Callum. And great to hear the feedback that the show's going from strength to strength. Stumbled over that a bit. I think we took a little while to find our groove after transitioning from Pete to Mike. But I reckon the three of us are in a really good flow now, and we're covering some great topics for listeners. So, look, righto, I love this question because it highlights how misunderstood borrowing capacity really is. By the way, that wasn't a dig at you, Mike. I think that was just the reality of what happened.
He's sitting there with the tissues. I wanted to chime in and say, I love him, Mike. Don't worry about him.
It took a little while to get in a flow. I think it's going really well.
I thought we hit the ground running. It was awesome. It's just Mike had cheeky jokes and kept talking about sensitive political topics, so we've got a couple of crappy reviews. We've stayed in our lane since
then.
I
think it's just natural. It takes a little while to get in a groove. So look, I love the question, Callum, and it highlights how misunderstood borrowing capacity really is. The short answer is this, that yes, positively geared properties can help borrowing capacity, but they're not guaranteed to. And how much they help depends entirely on the lender and how they treat both the income and the existing debt. So in this case, we actually used a serviceability calculator from one of the major banks to keep it simple. And person A can borrow around another $297,000, while person B, with the extra $10,000 of rental income, can borrow extra. Even with the shading, they'll be able to borrow about an extra $38,000. So it doesn't, even when it's a low negative geared amount like that, that wasn't enough to mean that their borrowing capacity was reduced or totally neutralized, it did give them an extra $38,000.
Yeah.
That's interesting, and a noticeable difference, like the best part of 40K, which can make a real difference for people that are on the hunt. But unfortunately, not everyone gets the same result with every bank, though, Dave, because you've sort of got to run the numbers within their own policies. So it's hard to give a definitive, this is exactly what every bank will do.
Yeah, 100%. So we might have went to another major and it might have been $5,000 extra, and we might have went to a second, a non-bank lender who doesn't have to be regulated by APRA, which we've just done an episode on, and they might be able to borrow an extra 60,000. So 6 times the debt to income ratio there of $10,000. So 6 tens are 60,000 for those who listen to our APRA episode. So yeah, look, some lenders will take 100% of rent, and that will generally be a non-bank lender, whereas the majority will take 70 or 80% of your rent down as income. So there's some shading right there. Then you have some lenders who, and again, it's a non-bank lender, who will apply only a 1% buffer to the interest rate you're about to pay, whereas the banks must apply a buffer of 3%. So, some will treat overtime, bonuses, casual income, self-employed's different. Some lenders will look at the last year's income for someone who's self-employed, whereas many will take an average of the last two. And if the second year was lower than the first, there might be other restrictions. So, the selection of the lender and how it relates to your income type matters. And so do actual living costs. So some lenders will be stricter with private school fees, or, some types of your living expenses will be more restrictive on your borrowing capacity. It might be high health insurance. It might be high discretionary spending can reduce your borrowing capacity dramatically. So also not all living expenses are created equally, shall we say.
Yeah. So the lesson is that positive cash flow helps, but the lender's calculator decides just how much it helps.
Yeah, that's spot on, Kate. There is no single borrowing capacity. It's lender specific.
Yeah.
And that's why when people try to estimate their borrowing capacity by using an online serviceability calculator or just one lender's calculator, it's unreliable, and because it's so limited in its scope.
Yeah. I think that's a really good learning because a lot of people, they feel resourceful and they think they can click around and research on the internet or whatever. And the nuances between lenders and the different products, it's startling.
And
And like you
policies.
said, the way that they look at even personal expenditure, it's all
Mm,
very different and it all feeds directly into borrowing capacity.
yeah.
Now, I'd like to ask about the next question. With the rise of Airbnb and other short term rental platforms, plenty of investors are wondering, how does a short term rental affect your borrowing capacity?
Yeah, so this is one of those areas where a lot of people have obviously now owned Airbnbs or short-term rentals, and it's looked at very differently from lender to lender. So, and we're having more and more of these nowadays, these types of properties. So, yeah, it really is treated very different from a standard lease. As I mentioned before, with a regular investment property, some lenders take 100% of rent, others might take 70 or 80%. But with short term rentals and things like Airbnb, it does depend on the lender. That income might be shaded back to 60%, 75%, or in some cases, some lenders won't factor it in at all. So, there's a huge difference. But as a general rule, it's shaded to a greater level than for a long term lease.
That sort of makes perfect sense to me, because if we're comparing Airbnb to the longer term rental market, like with the standard lease, you've got a tenant locked in for presumably at least 6 months, but typically it'll be 12 or it can even be longer. So there's a consistent income. There's, a contract in place to say that this is what the rent is for that particular period. With Airbnb or other short term, income can fluctuate week to week. There's peak seasons if it's in a location that's going to see those fluctuations. There can of course be the quiet periods or the little downturns. If it's a seaside location, it's going to be less interesting in winter. Cancellations, gaps between bookings. You've also got the owner just sort of deciding how much they might want to stay in it themselves if it's a bit of a holiday accommodation. So the marketplace can be really, really fickle. So I mean, I always talk about banks, shading like the fun police, but there is risk involved in the short term that needs to be factored in, right?
Oh, I totally agree. Like Mike, you mentioned, when owners want to live in these properties, more often than not, I mean, I deal with it all the time because people come to me with these ideas and I usually say, no, we're not doing that. But if you're buying something coastal and you're Airbnbing it because you want to earn some money while you're not using it, almost always the owner wants to go and enjoy it at peak season. Nobody wants to take August off and stay on the coast. They want to be there in January, and that's when your potential to earn the most money exists. And so I think banks are really onto this. I'm sure there are some people that do way better commercially out of their Airbnb because they do suck it up and go down in August and rent it out for top dollar in Jan, but it doesn't usually work that way.
It's funny, isn't it? Because if it was me with an Airbnb, I'd be like, oh, yeah, it'd be good to go and check it out. And then I'll look at like what it brought in the previous week and I'll be like, oh, I can't afford that. Like,
Yeah,
it's not
exactly.
really
That's what you're
mine.
giving up.
I need the money.
Yeah, I think, and that's why the lenders have to take this more conservative approach because it can be so up and down, and it's why it's also a higher risk to buy a property where you plan to live in it or use it as a holiday house for part of the year and lease it out for part of the year. You've got to be clear on what your cash flow outcomes are going to be and how much flexibility you can have in that space before you take on a decision like that.
Yeah, so you might have a great high yielding Airbnb, but the bank will still not take that full rental income and pop that into their calculator. They'll shade it.
Yeah, and look, that's exactly why lender choice matters, and why you want a mortgage broker and their back office team who knows this stuff like the back of their hand, because the way each lender treats short-term rental income can make a surprisingly big difference to your borrowing capacity.
Yeah, well said. Well, let's move to our next burning question. Why would anyone choose interest only repayments when the interest rate is higher and you're not reducing the principal?
Yeah, so look, this is a very common question. We've definitely tackled it at times across our 340 episodes. Um, so, yeah, we'll tackle it again because it just comes up so often and a lot of people aren't across it. So, look, interest only makes sense when you're claiming tax deductions on an investment and you still need to pay off your home or non deductible debt. The home is not tax deductible. So, although your rate is often lower than investment and interest only loans, after your tax deduction, the true cost is less. So, because you can minus effectively the percentage of your tax deduction off the interest rate, that's really so therefore you're paying a much lower interest rate. So, when you're in that situation, that's why you focus on paying off your home loan first.
Yeah.
I want to ask you something about that, Dave. I wonder if you kind of think about this way. So there'll be an investor sort of thinking, oh gosh, like if you're not paying it off, like are you actually getting ahead? But when we think about the impact of inflation with existing debt, let's say you owe 500 grand, like in 10 years time, 20 years time, 500 grand is not going to be like what it is now, if that makes sense. So if that property is appreciating in value, which, like if you're patient, it's hard to find locations that won't increase in value. So you might not be physically paying it down, but your debt to asset value ratio is widening. So in a sense, you are kind of paying down the percentage of liability. Do people think that way?
Well, I mean, I've talked about that concept a number of times on the podcast that because of inflation, and it's not just ideally the value of the property is increasing over time, but also the rent is increasing over time. So the rent relative to the interest or the size of the debt should be reducing. And then, hopefully your income's increasing over time as well at the pace of inflation, if not above. So yes, proportionately and relatively speaking, your debt becomes less as long as you're in a country where, those things are happening, where your inflation's going up, the value of the property, rent, and your income. So yeah, relatively speaking, your debt actually is reducing, even if you aren't actually paying it down. So that is another key factor with why the power of time and why it doesn't have to be paid down, particularly if you're paying down a home loan.
Yeah, great answer. It makes a lot of sense. What about if you own a home, but it's unlikely to be your long-term home and you'd like to try and keep it as an investment down the track?
Yeah, again, this is one we keep sort of touching on because a lot of people aren't aware of this, but it's a really great example of where people need to think strategically about the future use of their property. So, for example, if there's any chance your current home might become an investment property later, or even if you'd like to just put your best foot forward, that you would be able to keep your stepping stone home when you upgrade and turn it into an investment property, keeping the debt high, if you like, and not paying it down, which is in essence, I like to use the phrase preserving your debt, that can actually benefit you because the interest will then become, when it becomes deductible down the track, you've got greater tax deductions. And flipping the other side of the coin, you've built up greater savings to go towards reducing the debt on your future home. So, paying the loan down aggressively today will actually reduce those future deductions, and also it'll reduce the chance of you being able to keep that home from a financial perspective and turn it into an investment property.
That'd be a funny little like Dave Johnston quote: "Keep your debt high and don't pay it down." Taken completely out of context, but in this instance, it kind of works, right? Because it's strategy. It's not about
Yeah.
like being
You're in
lazy with
control
the
of your money.
repayments. Yeah, it's about, okay, well, at some point in time, decisions that I make here to pay it down will actually come and bite me on the backside. So,
Yeah.
yeah, I mean, I would love that to be the title of the episode. That'd be clickbait as hell, but that's
Yeah.
probably not our style.
Well, we'll say the property trio says it, so not just me. He'll probably get us more clicks. And listen, so yeah, look, exactly. The problem we quite often see is that people have not thought that far ahead. Now, whether that's property decision making or mortgage strategy, the two go hand in hand. And they haven't considered how their plans might change in 2 years, 5 or 10 years. So often by the time people come to us, they've already paid down a lot of the debt on the existing home, which would later become an investment property. And they've effectively cost themselves thousands of dollars in tax deductions. And when you think about compounding those tax deductions over a lifetime, let's say you're upgrading your home at 35, turning the first home into an investment property, you might have 30 years of tax deductions that you're missing out on. Now, if you do end up selling that asset instead of holding it, that might be $1 million of wealth that you've lost because you've actually ended up selling the asset because you didn't preserve the interest and the tax deduction. So there wasn't a strong enough financial case to keep it when it came to upgrading the home. So, these decisions just aren't about the interest rate on a loan. They're about, and they're not just about now, they can be about decisions that can actually roll into decades. And, that's where it makes a big difference to your bottom line when you hit retirement.
Yeah, look, for investors, the cash flow management and tax planning, that matters more than simply just paying down the debt as fast as possible. We sort of talked about that on the show with some of those mortgage myths a couple of episodes ago, where, my parents' generation was like, pay it down as fast as you can, and only a house would you ever get a mortgage for. You'd never borrow money for a car and all of those sorts of things. And I have to remind myself when I'm giving tax advice around investment properties and tax deductions that tax is not the reason to do everything. So people will sort of say, oh, I've bought this investment and I'm going to live in it. I'm like, don't live in it. And they're like, what do you mean? Well, that's not a good idea for the deductions, especially if it's brand new, because you'll kill off the Division 40. But I have to remind myself, well, people also want to live their lives as well. But where it kind of fits within the plan for you as an individual, you want to maximize those deductions as much as property. So as possible. So it is quite nuanced, and a lot of people don't necessarily have the education or the advisors to help them. Your average lender or mortgage broker might not even necessarily be up to the task there. You need someone that can lean into the strategy, and that, I think, is a really good example of, again, referencing that mortgage myth episode, why the interest rate isn't the only question that you should be asking a bank or a broker. And I don't even want to say bank or broker. I'd rather say broker.
Oh, nicely said.
Well,
Mark. I
you're
completely agree.
cutting off so much of the marketplace if you're dealing with a lender direct, aren't you?
That's all. That's what it is. You're not getting someone who's in a position to compare to other products. They're paid not to do that. It's,
They're
we
paid
talk
to
about.
sell their products only.
That's right. It's
Yeah.
we talk about going to a buyer's advocate that it can canvass the whole market and isn't buying off a stock list and working for a developer. And I'm not suggesting that it's quite that crude when it comes to banks, but you're not getting the whole market when you walk into a branch. You're just getting that business's loan offerings.
We covered that in quite a lot of detail in that episode as well, which I'm sure somebody more diligent and cleverer than I am will reference that in the show notes.
Well, I've got
I'm sure
one more
Anne-Marie,
tricky.
in her related episode, she says at the end of the episode, we'll mention it as one our listeners should listen to if they stick around to the end.
Yeah, and like one of the big things was that brokers actually have an interest. Well, they have a requirement to act in the best interests of the borrower, whereas the bank doesn't. Like if you work for, let's say, CBA, it's not incumbent on you to go, well, ANZ are offering this, or whatever bank is offering that. It's just like, we know our products, and we just share that. It's like that was an astounding sort of learning for me.
It also provides a tendency, and I found this really early, like way back, even when I left the bank and started mortgage broking in my mid-20s, what I would find is people at lenders would tell people they could do something, like they could get them approved, even when they couldn't. Right. So that is one of the big things when you're going with a lender direct, is they're so desperate to hold on to the customer. So that was a really early learning for me, a powerful thing to say, look, unfortunately, at this point in time, you can't do that. And people respected that much more. They're more likely to come back to you. But also often you could find a way. But what I found often with lenders direct is they will tell people they can achieve something for them, and then they'll find out a month later that, oh, sorry, we can't do that for you.
Yeah, wow. That's just awful. Talk about messing people around and creating risk. Well, I've got another question.
I hear it's a tricky situation.
I've got a tricky situation question for you, Dave. Someone sells their owner-occupier home, pays out their home loan, and also pays out investment debt that was secured against the home, and then wants to recreate that investment debt when buying their new home. Is that new debt still deductible?
That's a great question. It is a tricky and sticky situation, Cate. The answer is no. Once the investment loan is paid out and closed, it's gone from a tax perspective. So what we're talking about here is when someone has used some equity against the family home, for example, to go towards paying for, let's say, 20% plus costs of an investment property. So for just take it up a level, you've owned the home, you've paid it down, you want to buy an investment property, you then borrow 20% plus costs against the home, and you borrow 80% against the investment property. So you fully fund the full investment property plus costs to maximize your tax deductions. You've got your investment property ticking away. You then sell your home and buy a new home. But unfortunately, the equity you've used for the investment property or properties, that loan gets closed as part of the process. and then you take out a new loan against the new home, people think they can then just reinstate the new investment loan, but you can't. And so they often have paid out a big chunk of tax deductible debt without even realizing it, and they've worked with a bank or a broker who actually hasn't recognized this through the process and had a plan to make sure that that debt stays in place.
Yeah, messy, isn't it? If you don't
But it's a
know.
great example. All these little sort of nuances and bits, that you can, as a borrower, you don't have the expertise in this space, so you you don't know what you don't know
That's
if
right.
you don't
But
get
once
the
you've done it, it's
strategic
too late.
advice. Once
Can't
you've
turn it
done it,
around.
it's done. Exactly. Yeah.
So, well, to change up the scenario, what about someone who sells their home before they've bought the next one? So, for example, they move back in with mum and dad while they search for that next property.
Yeah, so look, what you can do to overcome this is potentially you just keep that 20% loan in place and set a term deposit against it because you've got the cash from selling your house. So you keep a term deposit as
Yeah.
security against it. And then, you can still use those funds towards the future home because that new home can then secure the investment debt. But in the meantime, in that gap period, you're able to keep that investment loan sitting there.
Yeah.
So, in essence, you've segmented it off as money that you can't touch, but that now will form the basis of security for the loan.
Yeah, exactly. It does allow for the loan to stay open in the interim, which means you can preserve the tax deductibility until you've purchased the new property and can transfer that loan to the new security and keep claiming all those deductions. But once you've paid it out, it's gone forever. It's just like we've talked about in that Mortgage Myths episode. Once you pay down a loan, you can't redraw it up and claim it for the original purpose. If you redraw it back up, you then pay for the jet ski. Well, then you've now got non-deductible debt inside of that loan split, which then has all other issues because if you ever do pay that debt down the track, for every dollar passed has to be equally apportioned to paying down the jet ski, and it's not deductible. So basically, before you pay down any debt, just make sure you know what you're doing because even though it's counterintuitive, and I remember talking about this a lot in the early mortgage strategy episodes, a lot of these strategies sound counterintuitive, but they can cost you in the long run. So before you pay down debt, understand if there's any long-term impact for doing so.
If you are going to buy a jet ski, do it under an ABN of Dave's Jet Ski Tours. It'll be tax deductible.
Pay for it in cash.
Advice.
Pay for it in cash, not through redraw or a loan if you can.
Oh my gosh, it's such a minefield for someone who doesn't know all of this. And I love what you've pulled together, and your team have given you some great examples of typical questions. You've inspired me to have a crack next time it's my turn to list my, 6 most common questions as well, because it's great. A lot of people are too afraid to ask, and it's been wonderful to unpack it all.
Well, Dave, thank you very much for putting that awesome episode together. And thanks, Callum, as well, for your awesome question. We covered a fair bit: positively geared, assessments, offsets, redraws, interest only, and all of the tax and traps around debts. So awesome episode. Now let's go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Well, my gold nugget is just you don't know what you don't know. And if you're going to make any major financial decision, you should be getting advice. And I think, Dave, you've shared that really well, where sometimes it can be a little bit counterintuitive. And in our heads, we're kind of thinking, well, debt is bad. If we have an opportunity to bury that once and for all, then we should take that with both hands. But there are some examples where that is actually, especially with the power of compounding, going to have a big dent in what your potential future could look like.
Yeah, that's right. 100%. Preserving debt, particularly if a property could be held on as an investment, can make a huge difference to your long-term tax deductions, and your ability to hold that asset make it financially viable. Plus, you'll have more cash to go towards a future home. So look, my gold nugget is when it comes to borrowing structure and tax outcomes, never assume what worked for a friend or a colleague will work for you. Your situation, your goals, and your timeline and your property strategy are unique. So that is why it is so important to talk to a strategic mortgage broker before you make any big decisions or go through major life changes. When you get the structure right at those turning points, you give yourself far more flexibility and better options for the future. And if you're unsure whether your loan setup is optimal for your future plans, my team and I are always here to help. So feel free to reach out.
On Cate's behalf, thank you for putting that one together. We lost her at the back end due to a technical issue, but I tell you where we won't have technical issues. That is in our live event, which we're very, very close to announcing a date. We can probably go so far as to say it's going to be early March. So jump on the Property Trio website. There is a form that you will be able to see. We'll chuck that in the show notes as well. We're taking pre-registrations for registrations of interest, and those people will be getting the first allocation of tickets when we're going live on that, which, as at the time of recording, is going to be very soon. And by the time this comes out, it might even be live as well. So we're pretty excited about that one.
Really looking forward to it. Our first live event after all these years. So first in, best dressed. There are limited numbers.
Awesome. We hope to see you there. And thanks for everyone with the questions. Everyone that's registered so far, we have actually got quite a few people that are pre-registered. So don't worry if there hasn't been any comms yet. We are just finalising some of those details and we'll be reaching out to you soon. So if you haven't registered, jump on. Otherwise, we'll see you next week.
See you next week.